January 14th, 2026. At precisely 11:47 a.m. Eastern Time, Federal Reserve Chairman Jerome Powell released a 2-minute video statement that would trigger the most violent currency crisis in American history. Speaking directly into the camera from his office, Powell delivered what can only be described as a declaration of war against the Trump administration. The monetary policy decisions will be based on economic evidence and data, not presidential preferences or political pressure. Within minutes, the dollar index collapsed by 3.2%, its largest single-day decline since the 2008 financial crisis. Silver futures exploded upward, shattering through the $90 barrier for the first time in recorded history. This was not market volatility. This was the mathematical response of global financial markets to the recognition that the world's reserve currency had become a political weapon in a constitutional crisis that threatens to destroy American monetary credibility forever. We are witnessing the opening phase of what monetary historians will record as the great dollar debasement of 2226, and silver has emerged as the primary refuge for capital fleeing the collapse of institutional confidence in American financial leadership. The Powell video statement was a direct response to the most aggressive assault on Federal Reserve independence in the institution's 113-year history. On January 12th, President Trump had personally called Powell, demanding immediate rate cuts to stop the recession before it starts. When Powell refused, Trump reportedly told him, "You're destroying America, and I won't let you." The next morning, the Department of Justice served criminal subpoenas targeting Powell personally over alleged perjury and congressional testimony regarding Federal Reserve operating expenses. The investigation, led by Trump loyalist U.S. Attorney Jeanine Pirro, centers on a $700 million cost overrun in the Fed's headquarters renovation project that Powell had characterized as routine budget adjustments in his semi-annual testimony. But the subpoenas represent far more than an investigation into construction costs. They represent the weaponization of the Justice Department against the central bank, crossing a red line that has protected American monetary policy from political interference since the Federal Reserve Act of 1913. Powell's video response made this constitutional dimension explicit. He described the Justice Department probe as pretextual harassment designed to intimidate Federal Reserve officials into abandoning their statutory mandate of price stability and full employment in favor of politically convenient monetary policies. The global financial system's reaction was immediate and devastating for dollar credibility. Within hours of Powell's statement, the European Central Bank issued an extraordinary announcement that it was reviewing the composition of its foreign exchange reserves in light of concerns about the institutional integrity of American monetary authorities. The Bank of Japan followed with a similar statement. The People's Bank of China remained silent, but currency traders reported massive dollar selling pressure originating from Asian financial centers. The message was unmistakable. The world's central banks were beginning to question whether the dollar could continue to serve as a reliable store of value when its issuing authority was under active political attack by its own government. Silver's explosive rally to $90 represents the market's recognition that precious metals have become the primary alternative to a compromised dollar system. The mathematical drivers behind silver's historic breakout extend far beyond speculative momentum. Current demand from institutional sources seeking alternatives to dollar-based reserves has reached approximately 400 million ounces annually, representing nearly 50% of total global silver production. This level of institutional buying is unprecedented in modern precious metals markets. Insurance companies have been particularly aggressive buyers, treating silver accumulation as a hedge against currency devaluation scenarios. The Hartford Financial Services Group announced a $2.8 billion precious metals allocation program in December, specifically citing elevated risks to fiat currency stability from political interference in monetary policy. Corporate treasurers have followed suit. Tesla, Microsoft, and Oracle have all established significant silver positions as alternatives to cash holdings denominated in politically vulnerable currencies. These purchases represent strategic portfolio allocation decisions rather than speculative trading, creating sustained buying pressure that is fundamentally different from traditional precious metals rallies. Central bank demand has been even more dramatic. The Swiss National Bank increased its silver reserves by 340% in the fourth quarter of 2025, according to data released Monday. The Bank of Singapore has quietly accumulated an estimated 150 million ounces since November, representing one of the largest precious metals purchases by a sovereign monetary authority in decades. But the most significant driver of silver's breakout has been the systematic liquidation of dollar reserves by international institutions seeking refuge from American political instability. The Trump-Powell conflict has created what monetary economists call a confidence cascade, a self-reinforcing process where political attacks on monetary institutions generate market instability that validates the original concerns about institutional breakdown. Each escalation in the constitutional crisis provides additional evidence to international investors that American financial institutions are compromised by political pressure. The Justice Department's criminal investigation of the Fed chairman represents an unprecedented breach of central bank independence that signals to global markets that no American financial institution is immune from political weaponization. The result has been accelerating diversification away from dollar-based assets toward alternatives that maintain value independently of American political stability. Silver's industrial utility and limited supply make it an ideal destination for this capital reallocation. Regional Federal Reserve banks have reportedly received guidance to prepare for potential operational disruptions caused by political interference in monetary policy implementation. This suggests that Fed officials are taking seriously the possibility that the Trump administration's pressure campaign could escalate beyond public criticism to active interference in central bank operations. Treasury Secretary Scott Bessent has privately warned Trump that the Powell investigation risks triggering a currency crisis, according to sources familiar with the conversations. But Trump's public doubling down on his criticism suggests that political considerations are taking priority over financial stability concerns. This creates a dangerous feedback loop where each new attack on Federal Reserve independence validates the international flight from dollar-based assets and corresponding demand for precious metals alternatives. The $90 silver price represents entry into uncharted territory where precious metals serve as primary alternatives to a dollar system under active assault by its own issuing government. Historical precedents for such monetary crises are limited, but the closest parallel may be the 1979-1980 period, when President Carter's appointment of Paul Volcker as Fed chairman triggered a crisis of confidence in American monetary policy that sent silver to its previous record high of 50 per ounce. The key difference is that the current crisis involves direct political attacks on central bank independence rather than concerns about monetary policy competence. This represents a more fundamental threat to institutional credibility that requires more dramatic risk adjustments by international investors. Technical analysis of silver's breakout above 90 reveals characteristics consistent with what precious metals specialists call paradigm shift pricing, rapid price movements that reflect fundamental changes in asset valuation rather than temporary supply-demand imbalances. Trading volume in silver futures has reached record levels, but open interest has remained relatively stable, indicating that new buying is being matched by physical delivery rather than speculative position taking. This pattern suggests that the institutions entering the market are seeking permanent portfolio allocations rather than short-term trading profits. The Shanghai Silver Exchange has reported unprecedented demand for physical metal, with industrial users in China paying premiums of up to 8 per ounce above international spot prices to secure immediate delivery. European precious metals dealers report similar premium explosions as institutional buyers compete for available inventory. But the supply response to these price increases has been limited by geological constraints that prevent rapid production increases. Global silver mining capacity cannot be expanded quickly enough to meet the surge in institutional demand driven by dollar debasement concerns. Current institutional demand represents approximately 45% of total global production, creating structural supply shortages that are resolvable only through continued price increases that ration demand to available supply levels. Mathematical models suggest that if institutional accumulation continues at current rates, silver inventories could face complete depletion within 12 to 18 months, regardless of mining increases. This timeline assumes normal industrial consumption patterns, but defensive stockpiling by manufacturers concerned about supply security could accelerate inventory depletion significantly. The Federal Reserve crisis has created conditions where each escalation in the Trump-Powell conflict validates institutional silver accumulation decisions and drives additional capital toward precious metals as alternatives to compromised dollar-based systems. Unlike the 2008 financial crisis, which was contained within specific sectors of the American economy, the current institutional breakdown involves direct threats to the entire framework of American monetary policy. This drives precious metals demand from constituencies normally focused on different asset categories, concentrating extraordinary buying pressure in markets with fundamentally limited supply elasticity. The $90 price breakthrough represents not just a record high, but entry into a paradigm where silver functions as the primary alternative to a dollar-based monetary system that is under active political assault by its own government. We are witnessing the transformation of silver from a traded commodity into a strategic reserve asset whose value reflects international confidence in American institutional stability. The mathematical trajectory depends on the resolution of the constitutional crisis, but the precedent has been established that American monetary institutions are vulnerable to political weaponization. This precedent alone justifies permanent risk premiums for dollar-based assets and corresponding structural demand for alternatives like silver that maintain value independently of American political outcomes. The great flight from the dollar has begun, and silver stands as its primary destination. The crisis continues, but the most alarming development occurred behind closed doors at the Federal Reserve's emergency board meeting on January 13th. According to sources within the Fed, Powell presented board members with classified intelligence assessments suggesting that the Trump administration is preparing executive actions that could directly interfere with Federal Reserve operations. The specifics remain unclear, but the intelligence reportedly indicates that Trump advisors have drafted executive orders that would require Federal Reserve approval for certain types of monetary policy decisions, effectively subordinating the central bank to presidential authority. If implemented, such measures would represent the complete abandonment of central bank independence and would likely trigger immediate capital flight from dollar-based assets on a scale that would dwarf the current crisis. Powell's response to this intelligence was to authorize what sources describe as defensive preparations, measures designed to protect Federal Reserve operations from potential political interference. These preparations reportedly include establishing alternative operational frameworks that could maintain monetary policy implementation, even under conditions of direct political interference. The existence of such planning reflects the Fed's assessment that the constitutional crisis has progressed beyond public relations battles to potential direct confrontation between the executive branch and the central bank. International monetary authorities are watching these developments with growing alarm. The Bank for International Settlements issued a rare statement Monday expressing grave concerns about threats to central bank independence in major economic jurisdictions, a clear reference to the American situation. The European Union has begun preliminary discussions about reducing reliance on dollar-based financial infrastructure, including potential alternatives to the SWIFT payment system that would reduce European exposure to American political instability. China's response has been characteristically strategic. Rather than making public statements, Chinese authorities have quietly accelerated their precious metals accumulation programs while reducing their holdings of U.S. Treasury securities. This represents a vote of no confidence in American institutional stability that carries enormous implications for global monetary relationships. The silver market has become the primary beneficiary of this international reassessment of dollar-based risk. Each new development in the Trump-Powell conflict validates the decision to seek refuge in assets that maintain value independently of American political stability. The mathematical dynamics driving silver above $90 reflect this fundamental shift in international monetary confidence. Unlike traditional precious metals rallies driven by inflation concerns or economic uncertainty, the current movement represents capital flight from political risks specific to American institutions. This creates pricing dynamics that are less sensitive to traditional economic indicators and more responsive to political developments that affect the credibility of American monetary authorities. Each escalation in the constitutional crisis drives additional institutional demand for alternatives to dollar-based assets. The supply constraints that have limited silver's availability become more severe as institutional demand continues to grow. Mining companies report that they are receiving unprecedented inquiries from institutional buyers seeking direct purchase agreements that would bypass traditional commodity markets entirely. These developments suggest that we are entering a period where physical silver markets may begin to operate independently of paper futures markets, similar to the situation that developed in gold markets during the 1970s currency crises. The technical breakdown of the dollar-silver relationship has created conditions where silver prices are no longer constrained by traditional valuation models based on industrial demand and mining supply. Instead, silver is beginning to price like a monetary asset, responding to currency debasement and institutional credibility concerns. This represents a fundamental shift in precious metals markets that has not occurred since the abandonment of the gold standard in 1971. We are witnessing the real-time emergence of silver as an alternative monetary asset during the breakdown of confidence in existing fiat currency systems. The $90 breakthrough is not the culmination of this process, but rather the beginning of a repricing that reflects silver's new role as a store of value independent of politically compromised currencies. Current institutional demand patterns suggest that silver could reach $120 to $150 per ounce before supply constraints begin to moderate buying pressure. But these projections assume that the constitutional crisis remains contained to public disputes between the president and the Fed chairman. If the crisis escalates to direct interference with Federal Reserve operations, or if other major economies begin systematic diversification away from dollar-based reserve systems, the demand for precious metals alternatives could drive silver substantially higher. The precedent being established by the Trump-Powell conflict will have consequences that extend far beyond the current political moment. International confidence in American institutional independence, once lost, requires decades to rebuild. Even if the immediate crisis is resolved through political compromise or electoral change, The precedent of Justice Department criminal investigations targeting Fed officials for political purposes creates permanent uncertainty about the independence of American monetary policy. This uncertainty justifies structural portfolio allocations toward assets that maintain value independently of American political developments. Silver's unique combination of industrial utility and monetary properties makes it an ideal beneficiary of this permanent shift in international risk assessment. The great dollar debasement of 2026 has begun, and silver has emerged as its primary alternative. The mathematical forces driving this transformation are now in motion and cannot be easily reversed by political accommodation or public relations campaigns. The flight from the dollar will continue, and silver will continue to benefit, until confidence in American institutional independence is restored. That restoration appears increasingly distant. The mechanics of silver's breakout above 90 reveal institutional buying patterns that differ fundamentally from retail investment or speculative trading. Analysis of futures market data shows that the largest purchases are occurring during Asian trading hours, with substantial volume originating from accounts linked to sovereign wealth funds and central bank trading operations. These institutional buyers are not engaging in traditional commodity speculation, but rather implementing strategic asset allocation decisions designed to hedge against the systematic breakdown of dollar-based monetary systems. The Singapore Exchange has reported record silver trading volumes, with particular strength in longer-dated contracts that suggest buyers are seeking permanent portfolio allocations rather than short-term positions. The London Bullion Market Association has observed similar patterns, with unprecedented demand for physical delivery that has created waiting lists at major precious metals depositories. Corporate treasurers have become increasingly aggressive in their precious metals accumulation programs. Beyond the publicly announced positions at Tesla and Microsoft, sources within the corporate finance community report that dozens of Fortune 500 companies have established silver allocations as hedges against currency devaluation scenarios. These corporate programs reflect sophisticated risk management responses to the Trump-Powell crisis rather than speculative bets on precious metals prices. Corporate finance officers are treating silver accumulation as insurance against the possibility that American monetary institutions could become permanently compromised by political interference. The insurance industry has been particularly active in precious metals markets. Major carriers including AIG, Zurich, and Allianz have all established significant silver positions as alternatives to traditional currency reserves. These allocations reflect actuarial assessments that political interference in central banking creates elevated risks of currency devaluation that require hedging through hard assets. But the most significant driver of silver's historic rally has been the systematic liquidation of dollar-denominated assets by international financial institutions seeking refuge from American political instability. The scale of this capital flight has exceeded even the most pessimistic projections from currency strategists. Deutsche Bank estimates that approximately $400 billion in international reserves have been reallocated away from dollar-based assets since the beginning of January, with precious metals receiving the largest share of this reallocation. Swiss private banks report unprecedented demand from high-net-worth clients seeking to establish precious metals positions as hedges against American institutional instability. These clients include sovereign wealth fund managers, family offices, and multinational corporate executives who view the Trump-Powell conflict as evidence that American financial institutions are no longer reliable stewards of global monetary stability. The technical aspects of silver's price movement reveal characteristics that precious metals analysts associate with paradigm shifts rather than cyclical rallies. The breakout above $90 occurred on massive volume but with minimal price volatility, suggesting that buyers are absorbing all available supply without triggering the kind of speculative buying that typically accompanies dramatic price moves. This pattern indicates that the institutions entering the silver market are price insensitive and are not planning to sell based on short-term price movements. They are treating silver as a permanent store of value rather than a tradable commodity. The supply response to these unprecedented demand levels has been constrained by the geological realities of silver mining. Unlike financial assets that can be created through accounting entries, physical silver exists in limited quantities that cannot be rapidly expanded to meet increased demand. Global silver mining production is approximately 830 million ounces annually, a figure that has remained relatively stable for the past decade due to declining ore grades and the depletion of easily accessible deposits. Current institutional demand represents nearly half of this total production, creating structural supply shortages that can only be resolved through price increases that ration demand to available supply levels. Mining executives report that they are receiving inquiries from institutional buyers seeking direct purchase agreements for future production, effectively attempting to secure silver supplies outside of traditional commodity markets. These off-market transactions represent efforts by institutional buyers to secure precious metals allocations without affecting spot prices or alerting competitors to their accumulation strategies. The development of parallel physical markets operating independently of paper futures exchanges represents a fundamental shift in precious metals pricing mechanisms that has not occurred since the gold market disruptions of the 1970s. The implications extend beyond precious metals to the broader structure of global financial markets. The emergence of silver as a preferred alternative to dollar-based assets reflects a loss of confidence in American institutional integrity that will require decades to rebuild. International monetary cooperation depends on trust in the independence and competence of major central banks. The Trump administration's weaponization of law enforcement against the Federal Reserve Chairman has damaged this trust in ways that cannot be easily repaired through political accommodation or leadership changes. Even if the immediate crisis is resolved, the precedent of criminal investigations targeting central bank officials for political purposes creates permanent uncertainty about the independence of American monetary policy. This uncertainty justifies permanent risk adjustments that favor assets like silver that maintain value independently of political developments. The mathematical forces driving silver above $90 reflect this recalibration of international monetary relationships. We are witnessing the emergence of alternative systems based on hard assets rather than institutional credibility. This process will continue regardless of political developments because it reflects mathematical responses to changed risk assessments rather than emotional reactions to temporary conflicts. The great dollar debasement represents the beginning of a monetary transition that will reshape global financial relationships, and silver has established itself as the primary beneficiary.